In early 2023, Donald Trump made a remark that barely caused a ripple on mainstream news, but it was like an earthquake to anyone who watches gold. At a gathering in Mar-a-Lago, he told the room, "We used to have something called the gold standard. It was beautiful. We had real money. Now it's paper backed by nothing. That will change." Most people shrugged and moved on. Gold investors didn't. They heard a former president hinting that the way America thinks about money could change again. Then, in mid-2024, on the campaign trail in Iowa, he went further. He said that on his first day back in office, he would restore sound money and make the dollar strong again, backed by something real. Commentators on television treated it like any other campaign line. But Trump is not known for throwing around technical monetary language by accident. And when you look at the people he keeps close, the picture sharpens. Around him are voices like Judy Shelton, who has openly argued for a currency tied to gold. There is Robert Lighthizer, who believes the current dollar-based system hands an unfair advantage to China. There is Steve Bannon, who talks about economic nationalism and sound money as core to restoring American power. Taken together, it doesn't look random. It looks like a team chosen for a specific mission: to drag the United States back toward a gold-linked dollar for the first time in nearly a century. The year circled on this plan, according to the pattern, isn't arbitrary. It's 2027. In this view, that year becomes the pivot point of a new monetary era. Not just another policy tweak, not just a change in interest rates, a full-scale reset of what a dollar is. Under this theory, gold would be repriced, not a little bit, but by a factor of 10 or even 20, instantly changing who in the world is rich and who is ruined. Those who hold physical metal become dramatically wealthier. Those who sit in paper, claims on that system, dollars, bonds, savings accounts, see their purchasing power collapse. And here is the key twist. The move wouldn't be sold to the public as a financial experiment. It would be packaged as a national security emergency. Because while Washington has been printing, China and the BRICS countries have been quietly working on their own alternative, a currency backed by gold and commodities that could displace the dollar. In this narrative, Trump's reset is a preemptive strike. Return to gold before they do. That's the story this documentary is telling. But before you can understand why someone might push for such a radical shift in 2027, you need to know what the gold standard actually was, how it operated, and why it was dismantled. Because once you see that history, a pattern emerges. Every few decades, when debt and inflation get out of control, the system is changed from the top down. It has happened before. The argument here is simple. It's happening again. For more than half a century, from the late 1870s until the early 1930s, the United States lived under what's called the classical gold standard. Every dollar represented a fixed slice of metal, just over $20 for 1 ounce of gold. If you held a $20 bill, you didn't just have paper, you had a direct claim on an ounce of gold sitting in a vault. You could walk into a bank, hand over the note, and walk out with the metal. This simple rule put handcuffs on the government. It could not create more dollars than it had gold to back. That constraint made it hard to inflate away debts or fund endless deficits. For decades, prices were relatively stable, and large-scale money printing simply wasn't an option unless new gold was found or imported. The gold standard didn't eliminate recessions, but it did anchor the currency in something tangible. Then came the Great Depression. By the early 1930s, the economy was shattered, unemployment was devastating, and political pressure was intense. President Franklin Roosevelt wanted to pump more money into the system, but the gold standard stood in his way. So he did something that, today, sounds almost unbelievable. In April 1933, he signed an executive order making it illegal for ordinary Americans to own most forms of monetary gold. People were required to turn in their gold coins, bars, and certain certificates to the banking system in exchange for dollars at the official price. Failure could mean heavy fines and even prison time. Once the gold was in government hands, the rules changed. In 1934, the official price of gold was raised, devaluing the dollar overnight. Citizens who had handed over their metal at the old rate watched as the state marked that same gold up by a huge percentage, effectively transferring wealth from private hands to the government with the stroke of a pen. With gold now priced higher, Washington could print more dollars on top of the same metal base. It was inflation by decree. After World War II, a new system emerged at Bretton Woods. The dollar was still linked to gold, but now only foreign governments could redeem it. American citizens were locked out. For the rest of the world, the dollar became as good as gold, at $35 an ounce, and it rose to the position of global reserve currency. Oil, trade, and savings were all priced in dollars. But the temptation to cheat was too strong. The United States quietly printed more dollars than it had gold to cover. By the late 1960s, foreign governments began to notice. France, led by Charles de Gaulle, famously started swapping its dollar reserves for gold, and even sent warships to collect the metal. Others followed. Gold began to drain out of American vaults. In August 1971, President Richard Nixon went on television and announced something that would later be called the Nixon shock. The United States would no longer redeem dollars for gold, even for other countries. The last link was broken. The dollar became a pure fiat currency, backed not by metal, but by confidence and military power. Since then, the amount of money in the system has exploded, and the dollar has steadily lost purchasing power. What once cost a single dollar in the early 1970s costs many times more today. The point the documentary makes is stark. The gold standard didn't crumble because it failed. It was dismantled because it worked too well for ordinary savers and too poorly for governments that wanted to spend without limits. Fast forward to the present era. For over 50 years, the world has run on a pure dollar system. The dollar has been the primary reserve currency, the unit in which oil is priced, and the backbone of global trade. But beneath that apparent dominance, three pillars are starting to crack: its role in central bank reserves, its grip on the oil trade, and the financial strength of the United States itself. First, look at reserves. Around the turn of the millennium, a large majority of global foreign exchange reserves were held in dollars. Over time, that share has slid downward as countries quietly diversify into other currencies and, most importantly, into gold. The reason isn't a mystery. When the United States used its financial system to freeze the central bank reserves of Russia after the invasion of Ukraine, every other capital in the world received the same message. Your dollar assets can be locked or seized if you fall out of political favor. The dollar was no longer just money. It had become an overt tool of policy. That made it less safe. Second, the so-called petrodollar arrangement is eroding. For decades, oil producers priced their exports exclusively in dollars, recycling those dollars into American financial assets. Recently, key producers have signaled a willingness to accept other currencies, especially from China. At the same time, the BRICS bloc, Brazil, Russia, India, China, and South Africa, now joined by additional countries, has been building alternative payment channels and openly discussing a currency linked to gold and commodities. If major oil deals begin to settle in such a currency instead of the dollar, the foundation of dollar demand shifts. Third, the United States itself is carrying a debt burden that grows faster than its economy. Federal debt has soared into the tens of trillions. Interest payments alone are rising toward levels that rival or exceed entire government departments. To keep the system functioning, the central bank has, again and again, expanded its balance sheet, creating new dollars to buy government debt. That process is politically easier than cutting spending or raising taxes, but it devalues every existing dollar in circulation. Meanwhile, central banks worldwide have been buying gold at a pace not seen since the early 1970s, just before the last major monetary break. Nations like China, Russia, Turkey, India, Poland, and Singapore have all steadily increased their official gold holdings. Many analysts believe some of them, especially China, have significantly more gold than they publicly admit. These purchases are not decorations. They are insurance against a future in which trust in paper claims evaporates. Put these pieces together, and a narrative emerges. The existing dollar-only system is strained, and rival powers are quietly lining up an alternative that leans on gold. In this environment, figures around Trump who champion sound money see an opening. The argument in this documentary is that if China and its partners move first with a gold-linked currency, the dollar's dominance could crumble. So the United States, under a president willing to shock the system, would need to move first. That is where the idea of a 2027 reset enters the picture, and where historical precedent becomes a playbook. If a future administration decided to reattach the dollar to gold, it couldn't simply make a calm announcement and carry on as usual. The script laid out here follows a historical sequence using Roosevelt's actions in the 1930s as a template. The first move would be to declare some form of national economic emergency. Modern presidents already have broad legal powers under various emergency and trading with the enemy laws. Those powers can be invoked when the country is said to face a grave external threat. In this scenario, the threat would be described as an economic Pearl Harbor, an alliance of countries preparing a gold-backed rival to the dollar. The message to the public would be simple and emotional. If America does nothing, its currency and standard of living collapse. Framed that way, opposition becomes easy to paint as unpatriotic or naive. Once the emergency is on paper, the White House would claim the authority to change the rules of money quickly. The second step would involve gold itself. A government that wants to back its currency with metal needs metal in its vaults. The United States already reports holding a substantial hoard of gold, but against a modern money supply, that hoard isn't enough at current prices. So the playbook calls for some combination of restriction and forced sale. Instead of outright banning all private gold, like in 1933, a new order might cap how much an individual can legally hold, allowing a small personal amount while requiring larger holdings to be sold to the Treasury at a fixed price. The third step is the heart of the reset, revaluing gold dramatically higher. Imagine the government declares that, from now on, 1 ounce of gold is worth many times today's price in dollars. On paper, the value of its own gold reserves explodes. Over a single weekend, the balance sheet of the state is transformed, not by digging new metal out of the ground, but by changing the number printed next to it. For anyone who still legally owns gold, their wealth soars in nominal terms. For those sitting in cash, the story is the opposite. Each dollar now buys a much smaller fraction of an ounce than before. The currency has been quietly devalued. Step 4 uses that devaluation to deal with the towering mountain of government debt. If every dollar is now worth far less in real purchasing power, then debts denominated in dollars become easier to service. The nominal figures on bonds do not change, but their weight in the real economy shrinks. Creditors, foreign governments, pension funds, insurance companies are paid back in full on paper, but the money they receive buys much less. It is a kind of default carried out through inflation rather than legal repudiation. Finally, step 5 is to unveil the new system. The dollar is declared to be backed by gold at the new, much higher price, but in a way carefully controlled by the state. Just as in Bretton Woods, ordinary Americans would likely not be allowed to walk into a bank and demand metal. At most, foreign central banks might have limited redemption rights. To the world, the United States would say, the dollar is sound again. It is tied to gold. Trust it. Confidence returns, at least for a time. In this 5-step process, an enormous wealth flip takes place. Owners of physical gold and certain hard assets are positioned to gain. Holders of cash and long-term bonds are squeezed. Governments that sit on large gold reserves see their power increase. Ordinary savers who trusted in paper promises find those promises weakened. That is what is meant by the largest wealth transfer in human history, not as a slogan, but as a mechanical consequence of changing the price of gold relative to the dollar. Why does this narrative keep coming back to 2027 instead of some vague future date? Because monetary history often moves in cycles measured in decades, not in months. Look back. The United States tied itself firmly to gold in the late 1870s. Roughly 50 years later, in the early 1930s, that structure was broken for citizens and the metal was revalued. A few decades after that, in the early 1970s, the last international link between the dollar and gold was cut. The spacing between these major breaks clusters around half a century. Count forward from 1971 and you land in the mid-2020s. By then, according to this script, several forces converge. Federal debt levels are even higher than today. Interest costs eat a larger share of the budget. The BRICS bloc has had time to roll out and promote its own gold or commodity-linked settlement unit. Oil and trade deals begin to clear outside the dollar system. Markets wobble as buyers demand higher yields to hold US debt. Domestic politics are polarized, but a second-term president, no longer constrained by the need to run again, has maximum freedom to do something drastic. In that frame, 2027 sits in the middle of a second Trump term, late enough for crises to ripen, early enough for executive action to shape the narrative. The argument goes like this: wait too long, and a rival gold-backed system takes hold, permanently weakening the dollar. Move early, and the United States can reclaim the mantle of sound money on its own terms, set the new gold price, and push the world into a fresh version of the dollar standard. Whether you agree with that logic or not, that is the timetable laid out. So how do ordinary people fit into such a story? The documentary divides them into broad groups. On one side are those holding hard assets: physical gold, productive land, real businesses, property finance with long-term fixed-rate debt. In a devaluation, the nominal value of those assets can rise while the real burden of their debts falls. On the other side are those whose wealth is concentrated in cash, savings accounts, and bond-heavy retirement plans. If the currency is sharply marked down, those paper claims lose purchasing power, even if the statements still show the same numbers. Historical episodes like 1933 and 1971 show that people who anticipated change and shifted into hard assets tended to fare better than those who trusted the old rules to continue. Some hid gold, some moved wealth abroad, some held real estate and watched debts shrink in real terms as prices adjusted. None of this guarantees what will happen next, and none of it is a personal recommendation. It is simply the pattern this narrative is pointing to. The conclusion of this story is not that a 2027 reset is guaranteed, or that one politician alone controls the fate of the global monetary system. Instead, it says the current structure is under strain. Rival powers are preparing alternatives, and a future administration may see a dramatic gold revaluation as the fastest way to slash real debt and restore confidence in the dollar. If that happens, those who hold claims on paper will experience the change very differently from those who hold claims on tangible assets. The reset described here is ultimately about choices by governments, by central banks, and by individuals. The claim of this script is that the pattern of past resets, the behavior of central banks, and the language of key advisors all point toward a window in the late 2020s. Whether you view that as a warning, an opportunity, or just an interesting theory, the message is the same. Understand how past currency resets worked, watch who is accumulating gold, and remember that when the rules of money change, the effects last for generations.